Well, good morning, and thanks for joining us today. This is the next part of our ROC webinar series on how to buy an apartment building in a tight market. There's an old adage that goes, knowledge is power, and clearly the same thing applies when we're in the apartment marketplace. My name is Jim Dimanis, and I'm the Chief Operating Officer of ROC Advisors. Today we are very happy to have with us one of the brokers here at ROC. His name is Erik Wyckoff. Good morning, Erik.
Good morning, Jim.
We've got Erik's bio up on the screen there, but Erik is a very important part of the ROC team, brings several years of experience to us. He has, I think it'd be fair to say that he's seen it all in this business, so we're privileged to have Erik join us today and talk about this very important topic. Just before we start, Erik and I were having a brief chat, and I think Erik said it best. What we want to do here is make the process less painful, understand and really know our market, recognize what our appetite is relative to risk, and really have trusted advisors that you can go to with the tough questions. So, how to buy an apartment in a tight market? Cap rates are low, interest rates are low, and availability is low. So, Erik, why don't I just sort of pass this on to you, and maybe you can talk a little bit about some of the variables that we have to consider.
Sure. I really think you need to start by understanding what your criteria is. Because the supply versus demand is so lopsided, it is more difficult now than at any time in the past to find suitable product for yourself, whatever is going to meet your business plan moving forward. Everyone is having the same experience. Even the large REITs are having difficult times finding suitable product. And the mid-market is experiencing the same, probably even a little more, because they don't quite understand the criteria that really fits their business plan as much, and they're not analyzing product as quickly as they should be possibly. Even before you leave your home, you really need to understand what the building is and the cash flow on it, the net operating income, and whether or not.
So, it's fair to say that there's a certain level of due diligence that has to be done, and it's just perhaps not being done. I think maybe it's not being done in the early stages. And that is when it should start, is very early in the stage when you first notice the product or the building being available on the marketplace. A lot of times when you're looking at numbers that are being reported, they're outdated, they're not accurate, and you need to be able to recognize this. And by understanding some criteria, it can really help you speed this process up without even having to leave your house. And I think the whole, the secret here is just, find a system that works for you, that is going to be a little quicker than possibly what you're using now, so that you don't burn yourself out, because this is not a quick process. Right. Unfortunately, if it is a quick process, consider yourself lucky, and the next one may not be as quick, so you're still in the same boat when you're trying to increase your portfolio size. So, go ahead, Jim. No, I was just going to maybe we can talk a little bit about location and how that factors into.
Well, I think it's key to really understand what your tolerance level is for how far you want to travel to your building, depending on whether or not you're going to be self-managing it or have a third-party management managing it for you. But even if it is a third-party management company, you're still going to want to visit the building occasionally just to check up on things. So you really need to understand which direction you want to travel in, depending on whether or not you're on the east side or the west side of the 404 or the 400. Are you flowing with traffic, against traffic, and how much time are you going to be in the car to get to the property and then return again all in the same day? Some people don't mind spending the whole day in the car, and other people just do not have that available time, and they may only have half a day to work with. So you really need to know how far you feel comfortable traveling, and anything outside of that radius, you don't even bother looking at it.
Yeah, I mean, really, and that's just very good practical advice. And I wonder how many people really consider travel time when they're looking at investments like this.
Yeah, well, I think they start to consider it after they've been starting to look for some buildings, and maybe they've driven outside of their comfort zone, and they're saying to themselves, you know what, this is too far. But what I'm saying is, even before that stage, just sit down and Google some addresses, whether it's Kingston or Chatham, going in two different directions, and check out your travel time. And also pay attention to whether or not you're flowing with traffic or against traffic, because that can really cut off some very valuable time or add valuable time to your journey.
Sure. Now, what about the apartment universe and number of buildings and units per building? How does that factor into the decision-making process?
Well, you really need to understand what your available cash is in order to make your purchase. And I think it's very important to look at, scales of economy of scale, and really understand the fact that the more doors that you have, the easier it is to manage the building financially, especially if there's unexpected surprises for maintenance. And so my thought on this is you should travel the furthest out that is comfortable for yourself in order to buy the most number of doors, unless you just want to be in Toronto. But if you're looking at return, net operating incomes, and having some good cash flow, I really think you should be looking at the outlying markets. The cap rates have compressed over the last few years in the outlying markets, and we're not seeing the spread between Toronto and the outlying markets as much as we used to. So sometimes you need to travel even further. But I just find it very important to have as many doors as possible under one roof. That way, when you do have repairs or you have some vacancies, at least you still have a good number of rents covering the expenses.
So would it be fair to say then the more doors under one roof are easier to manage?
It's easier to manage from a financial point, but also from a management person position, because the more doors you have, the more you can afford to pay a quality superintendent, even property management, with the number of doors generating rent, you may be able to afford a little better property management, which means you need to spend less time at the property. So number of doors is very important from management perspective, and also from having rents there to cover the day-to-day expenses of the building.
So just generating more cash flow.
More cash flow, more net operating income, and just the more cash flow flowing through the building. If you need to replace a roof, you rather have 40 doors to generate the revenue for that repair compared to 20 doors or even less.
Yep, no, that absolutely makes a lot of sense. And now that brings up, we talked about cash flow. So let's talk a little bit about the finance behind all of this.
Sure.
And how we can approach it.
Well, a lot of people make the mistake of trying to figure financing out during the due diligence period, and when they need to go to a lending institution and approach CMHC for a loan. And really that is too late. We're seeing a lot of deals fall apart, and it's really because people don't understand the availability of their funds, possibly where they're coming from, and how the process works, and what kind of criteria the institutions and CMHC have in order to advance money, a loan to value, and what type of net operating income they're looking for from a building in order to advance either 75 or 85% loan to value. If you're looking at a building and you think you're going to be able to purchase it for 20% down, and it turns out that you require 30% down to make the transaction work for CMHC, it's pretty deflating during the due diligence period, and a lot of times people just do not have that extra cash in order to make the transaction happen. And again, you're just, you're going down a road that is creating a little bit of pain. And, if this happens to you more than once and you're 12 months into looking for a building, you may get a little deflated and decide to stop, which is definitely not your goal.
So what should the average investor, would-be investor do? And one of the things that comes to mind is pre-qualified mortgage?
Yes, well, pre-qualified mortgages is not quite the answer when you're looking at commercial mortgages, because the first thing any lending institution in CMHC looks at is the cash flow in the building and what it will carry itself, and then they look at your net worth to see whether or not you're capable of doing the transaction. So unfortunately, you can't walk into a bank and say, I want to buy a building for $1 million. How much money do I need? Well, it depends on the net operating income in the building. You may only need 15%, or you may need 25 or 30% for the same.
Sure. So having said that, if I'm new to this and I'm going out and I want to buy a building, what's the advice? What are the kinds of things that I should be doing on the financing front when I'm dealing with banks or doing my due diligence? What can I do that could make me a more savvy investor, or at least allow me to capitalize on a good deal a lot more quickly?
I think one of the best things you can do, and there's all kinds of people to help you in this, is get in touch with a couple of the lending institutions that really specialize in lending money on these types of properties. They're more than happy to work with you because they're there in order to put loans on the books. Essentially, they're there as salespeople that need business, so they're always happy to find new clients. And it's just so important to be working with somebody that you can rely on, who will give you a quick turnaround on some questions on cash flow and what they think their opinion of what the loan to value will be on any particular building. There's also some really good real estate brokerages that understand financing, and you can also go to them. The key is having somebody on your team that understands how CMHC is looking at the building and what CMHC's criteria are if you're going to be using CMHC, so that you're comparing apples to apples on how everyone will be looking at it, not incorrectly. This really, at the end of the day, is the point. You have to be looking at the net operating income correctly, plugging in all the right numbers that will satisfy CMHC and the lending institutions. And a lot of times when you're looking at numbers on a building that is being sold, they don't include all the numbers in their expenses, which is understandable because a lot of them, it's standard industry numbers that are being plugged in at the financial institution level. So it's up to you to understand what those numbers are and plug the number in, or have somebody on your team that will do that for you.
So if I was a prospective investor and I came to somebody such as yourself, would you sit down with me and talk about the due diligence process and sort of have almost a checklist approach or a menu, sort of saying, look, Mr. or Ms. Investor, these are the kinds of things that you need to understand, and these are the things that have to be in order for you to be successful? I mean, is that the kind of conversation that you would have?
That is an excellent starting point. It's also a way to qualify the person that you may be sitting with. You really need to be working with people that are experienced in these types of purchases and understand the ins and outs in great detail. And so I would definitely be having those conversations with a number of people, trying to find somebody that you feel comfortable working with. And at the end of the day, if they teach you something in that meeting, perhaps they're qualified. If you haven't learned anything from the meeting, then maybe you need to continue your search for that team member.
Great. So I think that's actually dovetails really well into our next slide here, and that's determining what to buy and what type of buyer am I. So it would be great if you could give us a bit of some definitions here, the difference between a passive versus an active investor, and maybe talk a little bit about the fixer and also the user manager.
Sure, and this ties directly into location and having a area that you're comfortable driving to distance-wise, because if you're a passive investor, then you're not managing the building. You may only be going there once a month, and you can afford to have the building a little further away from your principal place of residence. If you're an active investor and you are going to be managing it and you are there every week, well, then you better make sure you feel comfortable with the distance the building is from your home. Otherwise, you're going to grow tired of sitting in the car and traveling to the building and want to sell it possibly, which again is not your goal. If you're a fixer handy person that wants to fix the building up and you need to be there for the first maybe half year working on the building on a regular basis, you better either be prepared to spend your time at the building overnight in one of the units, or again feel comfortable within the distance from your home base, and being able to travel to it on a daily basis. User manager, you could be looking at it as a retirement package, a place to live later in life. If that's the case, then do you want to live in that area? Does the area have the different features and benefits to it that will keep you interested in remaining in the area? But mostly it's the passive versus the active investor, and the time that is required, and traveling back and forth to the building. Great points.
Now, here we go. Available cash and sources. So getting back to this very important part of the equation, and that's financial analysis. You've given us a bit of an overview, but maybe you talk a little bit more about this, and as well as you're educating the guests that we have online. Something that I hear a lot about, obviously, in this business is cap rates, and how do we establish cap rates, and where do we find accurate information, because all of that really factors into the financial analysis, clearly, that we have to do, and it affects the finance. So as you're giving us an overview, Eric, maybe you can also touch a little bit on cap rates and how that factors into the available cash and sources.
Sure. Well, cap rates are really derived from the marketplace, from buyers and sellers coming together and agreeing on doing a transaction and closing at the end of the day. That is where your cap rate is being generated from. So if you're not actively in the market, it's really difficult to stay abreast of the changing cap rates. It's incredible how much they have changed in the last 2 years, 3 years, and 5 years. 5, 6 years ago, we didn't think the cap rates would be where they are today. So who knows where they're going to be in the future. But they're constantly moving up and down, down, up. They're just in fluctuation with the marketplace. So you really need somebody that understands the marketplace and what the current cap rate is. And when I say current, we're almost looking at the past 6 months. And it's hard to say where they're going to be in the next 6 months. But available cash, I mean, that can come from a variety of places. You may have cash in the bank, or you can take some equity out on your principal place of residence, keeping in mind that there is a tolerance level with the financial institutions on what the loan-to-value is on that leverage. You may have some other assets, stocks, bonds. I've seen a lot of people get out of the stock market in the last 2-3 years simply because their tolerance level has been reduced on that, and they've just decided not to be in that marketplace. Or you may have some other properties, some other multi-residential properties that you want to leverage, which is a great source of income if you've owned them for a few years with the compressing cap rates. You know, when a cap rate compresses by 3 points on $100,000 net operating income, that's some pretty substantial profit that can be leveraged and put into another building in order to increase the size of your portfolio. So it's just a matter of understanding what the lending institution's criteria are for this type of leverage and how much cash it takes in order to make a purchase, including your closing costs. And, land transfer tax from your lawyers, all that has to be calculated in.
Sure. Two questions for you. You talked about the tolerance levels of financial institutions. Would it be fair to say that the different types of financial institutions have different tolerance levels? And so when somebody's out there shopping for money, is that something that they should be aware of, that going to a type A bank might be a little different than going to either a private lender or
yes,
or a B bank?
Yes, absolutely. And even there's banks out there that like to do loans under $1 million, and then there's other financial institutions that they will only do loans over $1 million. So there's different sources of available funds, and they all have different criteria. And also money comes and goes. It depends on their investor pool and how much they have available to put out in the marketplace. So it's actually wise to be working with a couple or 3 top lenders within this field. You never know who's going to be short on money when it's time to write the loan on your new building.
So if I'm a brand new investor, never done this before, and I am looking at this part of the process, where would I start? Would I simply walk in to my neighborhood bank, or where I've been banking for the last 20 some odd years, and start there, or should I speak to a broker? Where do I start as part of the due diligence process? Where would people start?
I would start with all of the above. I would speak with brokers. I would speak with your branch. You need to keep in mind, though, the branches are not in the business of loaning money on commercial properties, and everything has to be approved by their head office. And believe it or not, the head offices of these different various branches have departments set up to speak to individuals and really appreciate the phone call and the business. So I would actually be going to the head offices of the different banks that you see on the street corners, and also speaking to some mortgage brokers, and just getting a real good feel for what people are sending back to you in information. But at the end of the day, you should be either speaking with an experienced broker that has many contacts at this level for this type of investment, or going directly to the head offices, and they will talk to you. People don't realize sometimes that, well, I have to go to the branch because that's the front office, but it really isn't for these types of loans.
So that's very important, and thank you for bringing that up. So what Eric, just to reiterate what Eric said, is that you have the ability to go to the bank's head office and seek out those professionals that work within those offices to talk about what your requirements are, what your needs are, as opposed to having to go through various levels of, I'll call it bureaucracy. That's probably not a very accurate term, but needless to say, you can save a lot of time and make the process a lot less painful if you go directly to the appropriate source.
Yes, and I do hear people say to me all the time, well, I've been pre-qualified for a $1 million loan. And when I do hear that statement, I kind of, the red light goes on a little bit, and I realize that, well, you really haven't been speaking to the right people, or they'd be telling you that this is the range that you can purchase in, but it's really going to depend on the building and the net operating income coming out of it. We need to see that before we can qualify you. In the residential is really a residential term, pre-qualified, and you can get pre-qualified based on your gross debt service ratio. You cannot do that for a mortgage. Commercial mortgage.
Right. Okay, survey says, survey noted that 52% of commercial real estate sales failed due to lack of financing. Is that true?
Well, this is actually an article that came across all the commercial agents or commercial real estate representatives' desk just recently from our membership, and in the article it did state that, and this is from NAR, National Association of Realtors, which is an American association, but it's very accurate right across North America. And the article actually said that 50% of all commercial real estate transactions failed during financing stages, due diligence. And I looked at that article and said to myself, it failed long before this stage, because if you properly understood the criteria of the lending institutions, and you crunch the numbers correctly, and you use the correct numbers, you should have known long before this stage that the building wasn't going to cash flow for the resources that you had to put into it, or what you wanted to put into it. Many times, people think they're going to be able to make the purchase for 25%, and it turns out to be 35%, and that should have been realized long before you go into financing. So, I think this should be maybe even half of that number, or a third of that number, if the numbers are being crunched correctly during due diligence.
So yet again, this just highlights the importance of doing proper due diligence and really understanding the transaction.
Well, it really does. Not only does it save you time, but it can also save you money, because once you're into the financing stage, you're starting to write checks possibly in order to, get your phase 1 reports, structural engineer, maybe even some resources for financing. So, it's a terrible time to have a transaction fall apart during financing, because you're well into the stages of due diligence at that point, if you're following the steps correctly.
Right. Okay, economies of scale. I mean, you touched on it, and I think I asked you the questions of a question. 100 units, easier to manage if under one roof. But maybe you can talk a little bit more about this and expand on these various topics.
Sure. Well, even though the cap rates have compressed over the last few years and half decade, the cap rates have actually been compressing since late 90s when we had the recovery in 96, 97. And even though the cap rates are as low as they are, there is still some good upside out there in buildings, just due to a lack of proper management over the last couple of decades, or however long somebody has owned the building, if they've owned it long term, or it's turned over a couple of times in the last 5 years, which you do see from time to time. So, understanding your economy of scale is, the number of units. Again, like you said, 100 units, you can afford to pay 2.5 superintendents on a building that size, and it actually takes almost that number of people to run a 100-unit building. But it just, when you have that type of management under the roof of the building, it's a little easier for you to manage it because you have quality people at site on a 24/7 basis. Again, repairs, is a great opportunity to find some upside in the building. You may look at the building and think, wow, this place is in pretty bad condition. I don't see it being of value. Where it can be the exact opposite. I have some great clients in the area that recently transformed a building just to an incredible level, and they're getting double the rents that the building would have been achieving in the condition that was when they purchased the building. So there are opportunities out there, and it all comes back to, understanding what is possible to achieve in the marketplace with the transformation. But at the end of the day, you want to be careful that you don't spend more money in the building than what the building is worth. So for every dollar you put into the unit, you want to be able to make sure that the rent that you can increase it by will cover that expense or cost of upgrade in your net operating income reflecting in the value of the building.
Sure, but and as it pertains to repairs, and this is a common theme throughout this particular webinar topic, you need to be prepared. You have to do your due diligence. So it'd be fair to say that when you're looking at a building that may require repairs, and you're thinking, hey, that to me represents potential, huge value and huge upside if I do these things. But clearly, we have to consult the professionals. Eric, I'm sure you would agree that it might be in our best interest to talk to or have an engineering study done, a technical audit done on the building, just to ensure that we're not running into something that is going to require a lot of capital money spent over the next over the next few years or immediate years. It could really put a damper on what your returns were.
Yes, absolutely. You need to be very careful. You can't throw caution at the wind. You either need to have had the experience and have some understanding of it and rely on your engineers, or just rely on your engineers if you haven't had any experience in the past. A lot of times people that are starting out in the industry, for the first time and looking for their first building, it's not always a smart idea to buy one that needs a lot of renovation. Unless you have some kind of background in that, because it does take a lot of work. There's a lot of hidden surprises when you start tearing the drywall off. You never know what's in behind it. So you need to be careful. You need to understand the process and rely on some people that are very experienced with the type of work that you're contemplating.
Good advice. And as you were talking about the walls and sort of ripping things down, two things came to mind, and that's the mold and asbestos. And obviously, when you're looking at a building of a particular vintage, you really need to be careful about those issues, and specifically asbestos, because all of a sudden your costs have now tripled or perhaps quadrupled if you're looking at having to do an asbestos abatement or anything of that nature.
Yes, it's very expensive, so it can easily triple your cost and sink you.
Right. So, and again, sort of some practical advice for for our audience. You talked a little bit about what a new investor should do or could do relative to financial institutions and then talking to people. What about the repair side of things? Would it make sense, no matter what size of building, to have a building inspection done, to engage an engineer? And if so, where do you go, or how could you procure those kinds of services? Can you talk a little bit about that?
Sure. Well, I always recommend having an engineer look at the building. From time to time, I will see a home inspector show up at one of our transactions, and I'm always wondering why anybody would go down that road. You're always best to engage an engineer, a structural engineer that has a lot of experience in the multi-res residential industry, and there is quite a number of them in the area that specialize in the multi-res and understand it really, really well and give you a projection of your costs moving forward for the next 10 years and what your year one cost is going to be, or what your day one cost is going to be. And again, CMHC and the financial institutions look at that very closely. If they come out and inspect the building, and if they see some repairs that are required in the very first year or the very first 90 days that you take the building over, they're going to reflect that into the loan to value that they give you. Not necessarily a loan to value. They'll still give you the same loan to value that they would have, but what they will do is a holdback. And so you have to have those available funds in order to do the repairs before they will release those funds to you. So it's critical. I always recommend calling in a structural engineer. It doesn't matter what the size of the building is, whether it's 6 units or 100. I believe that a structural engineer should be looking at it.
So it sounds like what you're saying, especially from a financing perspective, that certain mortgages, or it could be conditional that you do certain repairs in order to get some of this mortgage money.
Yes, especially if you're trying to achieve a high loan-to-value ratio, then you have to use CMHC. CMHC always comes out and inspects the building, and if they determine that the roof, just as an example, is at the end of its life and there's a risk to the building if you do not repair it, they will hold those funds back, the cost of the repair to the roof, until they have a letter from a structural engineer saying the repair was done. Then they advance you the funds.
Right. So again, another good segue to our next slide, and that's financial analysis. You talked about loan to value. You gave us a bit of a briefing on cap rates, but here maybe you can talk about how we determine a cap rate, the actual, I guess, the math, if you will, and then cash on cash and ROI.
Sure. Let's just touch on cap rates a little bit again. Many times, not many times, but a few times you will hear of a building selling for a cap rate that you just kind of scratch your head at. Why would anybody pay such a low cap rate? In the higher end market, the larger buildings, from time to time there's a cap rate of 3.5% or a really low number like that. And there has to be some upside in the building. Somebody that made the purchase recognizes some upside, and they realize that 12 months, 24 months down the road, when they've done their repairs and their upgrades to the building that they want, they're going to be achieving a much higher cap rate than that through the increased rents, and which is increasing your net operating income. But there's about 5 key indicators that you really need to look at when you're analyzing a building, but we'll just touch on 3. One is the cap rates. It's a pretty easy equation to work through. First of all, you just take your net operating income and divide it by either the purchase price or what you think the building is worth, and that's going to give you your cap rate. It's straightforward. Everybody understands it. But then there's also cash on cash, and the cap rate is what the building is performing at, where the cash on cash is what performance level is the cash that you're actually having to use to put into the building. What's your return on that money? And that number is always a little higher than the cap rate. So, cap rates may be low today, but your cash on cash can be substantially higher. And then your return on investment, a lot of people forget about this one, and that's your principal recapture at the end of every 12 months. You are making mortgage payments, and if you're making a mortgage payment, just a rough number to use, around $60,000, approximately $25,000, $28,000 of that, depending on your interest rate, is actually going towards your principal pay down. So your rents are paying paying the principal down, and that is a return on your investment added in with your cash-on-cash return, and that number starts to look pretty good also, even with the low cap rates. So you need to look at a number of key indicators, including your price per door for the marketplace and a couple of other ones.
Sure, but these really are your three more salient indicators.
Yes, these three here are your meat and potatoes of your return. You know, you want to look at price per door, because if for some reason the price per door is really high for what the building, the location of the building in the marketplace, then you need to ask yourself, okay, well, where is this price per door going to go? Where if you have a low price per door and all these other three numbers look terrible, if you have a low price per door, you may be saying, okay, so where's my upside? How can I bring my price per door up to what the marketplace is in this particular area? So you need to look at them from a few different angles and really start thinking upside with these low cap rates. Find buildings with upside, and there's plenty of them out there, especially in the mid-market.
And one other piece here that's not on this particular slide, but you know, we hear it a lot in our business. You know, more so I think from the larger institutional investors. But internal rate of return (IRR). Can you talk a little bit about that?
It's not a number that is used much in the mid-market, but your internal rate of return is what is your return over 10 years. It's a much more analytical process to understand it. And really what I like to look at in the mid-market is your return on year one, and I don't like to project too far out. It's not my area of expertise, and I don't think it's the expertise of the mid-market.
Right.
It's more something, you know, the REITs use, 10-year projections, and it's very difficult to start making 10-year projections for the mid-market. You really, all you need is a good software program and understand what numbers to plug in, but it's still, at the end of the day, I don't find it's a number that the mid-market is really focusing on.
Right.
Right. But it's a 10-year projection.
Sure. Okay. No, that's fair, and I'm sure, you know, people that are listening with us today will appreciate that, because they hear these terms and they think, wow, is this something that I have to be concerned about? Is it going to make a difference in terms of my decision-making process?
Well,
so,
I think what you really need to look at is an accurate snapshot of the building for the past current 12 months. What was the performance of the building for the last 12 months up until the last building cycle of all the utilities? And then that is going to give you an accurate picture of what the building is worth. You can't be using numbers that are 2 years old, and you can't be using numbers that are projected 2 years into the future. You need to know what is that building worth today based on the last 12 months and the performance of the building.
Great advice, and great advice coming from a real estate professional. And so, you know, everything that you've talking about, that you have been, you know, talking about and teaching us about, Eric, just points to this. You really need to consult a professional, don't you? You
really do. And it's easy to identify them, or identify people that are wanting to be professionals. You know, after a number of conversations with them, and you start getting into depth on conversations, you know, you kind of figure it out. But I think it's very important to deal with somebody that is actually specializing within the industry. Not a residential representative that would like to do a couple of multi-residential deals in his lifetime. You really need to spend your time with people that are fully involved within the multi-residential, including your engineers, your financing, and your real estate representative. Everybody, even your insurance companies. You have to be very careful. I mean, when you pick an insurance company, you're wise to choose one that has a lot of insurance policies on multi-residential, because then they fully understand what the criteria is if there's a problem with the building, and making sure the building was insured in the beginning. Your rents, your boilers, all of these need to be insured, and you need to be speaking to even an experienced insurance person.
Anything you'd like to tell us about Rock Advisors and we've some of the transactions, and of course, just here at our next slide, there's some resources on our Rock website
Well, we always enjoy working with new people. We also have some new people joining us, so we're going to be able to service a lot more people. So we are actually, very active within the marketplace. We're looking to expand and have been expanding over the last couple of years, and the next few years is looking absolutely tremendous for us with what is happening here. We're going to have some tremendous resources and availability of people to work with people one-on-one. And really zero in on the marketplace on, whether it's Hamilton or Belleville. We will be experts right across the province, and we will more than happily sit down with people and crunch the buildings, crunch numbers on buildings. I think it's important, one person can't see everything, so when you're out doing what you're doing in order to find a building, what you should have is somebody that is behind you that you can start sending information to, and then they analyze it. They look at it from a different point of view. They may have even known the building from a year ago. They may have toured it because they showed it to some other people. They may look at the numbers that are being reported and can instantly see that there's a problem with them. I really think you need to be out really doing everything you can and then funneling it to one person. Somebody that you can rely on, somebody that you're wanting to work with. And we have that ability here at Rock.
We absolutely do, Eric. And for those, again, for those that are with us today, I'd encourage you to go to our Rock Apartment Advisors website. That's www.rockaptadvisors.ca. It is a content-rich website. There's some it's a great resource, and there's some really good information. It's just it's a good place to start if you are considering investing, or if you're looking at people that you'd like to talk to, a trusted advisor. We here at Rock are certainly be counted on to do a good job for you. And as the COO, I can't say enough about Eric and just the value that he brings to our organization. Just by listening to his sage advice, it's pretty clear that Eric is somebody that understands the business, has been through a lot of cycles within the business, and we're very, very fortunate to have him. And so anybody out there would like to speak to Eric, either if you've got a question or would like to engage Eric for his services, then please do contact him. We've got Eric's information on the site right now. And so, Eric, what a pleasure. Thank you very, very much. And I hope you have a wonderful weekend. I hope you get some golf in this weekend.
So do I, Jim, but they're looking for rain all weekend. Thanks, Jim.
Well, that's not good. Well, take care, Eric.
Okay.
Thank you very much.
Bye-bye.
Bye-bye now. Alrighty, well, that was great, and thank you once again, Eric. So we've got some upcoming webinars, obviously, and we encourage you to visit our website, check out some of the great topics that we're going to be discussing, and we hope that you do join us. And once again, we really, really value your opinions, and if you've got any questions or any suggestions, please don't hesitate to send us an email or even give us a call. Co-brokerage opportunities, we're always looking for qualified, good people that would like to partner with us. We have some phenomenal opportunities, and we really enjoy meeting good people, good qualified people that we can do business with. If you are interested, then by all means, please contact Daryl McCullough. He is our broker of record, and Daryl would be very happy to speak to you and tell you more about our brokerage opportunities. We'd also like to thank RealTrack for the following sales information. So here we go. I said earlier that we are well on our way to $2 billion of sales this year, and I think we are going to get there. We're currently at $1.4 billion. Largest transaction last month. Wow, 130 Parkway Forest Drive, North York, $28 million. That is new construction. We'll go into a few more detail as we go on. And the highest price per unit was Forest Manor Road and 130 Parkway Forest Drive. And again, this was a portfolio sale at and it was $318,000. So last month's apartment transactions, again, primarily in the GTA, no big surprises there, 70%, and of course 20% in southwestern Ontario. Moving on, some of the recent transactions, 15 Wesley Street in Etobicoke, $191,000 per unit, so, well approaching that $200,000 per unit mark, and, those numbers say a lot. Again, in Etobicoke, 149 Alderbray Avenue, $189,000 per unit. Here we go. As we said earlier, this is new construction, built 2013, 85 Forest Manor Road, and as well 130 Parkway Forest Drive. So this was purchased, again, Parkway Forest Drive was purchased along with 85 and 95 Forest Manor Road for a total cost of $33,395,000. The sale price has been divided to reflect the cost per building. North York, $123,000, 1750 Wilson Avenue, built in 1953, 10 units. Roselawn Manor in Toronto, $74,000. An older building, 1955, had not quite at that $100,000 mark that we would typically see. Duplex and Eglinton area. This one here is in Oshawa. Oshawa hasn't reached that $100,000 mark. This is at 300 Montrave Avenue. 14 units built in 1960. Maitland Street, an interesting, sort of an iconic looking building. Price per unit, $97,000, and that's at the Yonge and Carleton area. This property has 2 apartment buildings and 1 house. Highland Park Apartments in Scarborough, $103,000. So it looks like the Scarborough number has the Scarborough values have gone to that $100,000 mark, and this is Bellamy and Lawrence. So this property is a 1960 style mid-rise, 68 units. Income demographic in this area is stable. Rents at this and competing properties are at the affordable mid-market level. Northcliffe Heights Apartments in Toronto, $59,000 per unit. Eglinton Avenue in Dufferin, again built in 1969. Terrace Gardens at Roseland Avenue, $85,000 per unit. Bathurst and Elm. Dufferin Heights, Toronto, Ontario, once again, $34,000 per unit, 1968, 91 units. Here we are in southwestern Ontario transactions, 60 Centreville Street, $112,000 per unit. And this is actually on a site with some density opportunities, 1.96 acres. Hibiscus Gardens, Huron Street, London, $46,000 per unit. Here we are in Chatham, Riverbend Tower, $6 million purchase price, $61,000. Again, here we are in Windsor, Sandwich Street, $40,000. Transactions now in the eastern and northern Ontario, Ottawa, Springfield Road, $200,000 per unit. Chanticleer Apartments on Nelson Street, $23,000 per unit on this one. That brings us to the end of our transaction snapshot. Once again, please check out our webinar schedule. We thank you so much for your time. We hope you enjoy this glorious day, and I hope that it doesn't rain because I'd love to get in some golf this weekend. Thanks again, and we will talk to you soon. Bye-bye.